Amy, let's talk about that uncertainty. Chair Powell referencing it. The market hates it. Uncertainty, incredibly difficult to deal with. It's not risk. It's not quantifiable. Amy, how good is the market at hedging geopolitical risk?
I would say the market is terrible. Prior to this geopolitical risk being on the table, the options market was actually doing a fairly decent job of pricing where they thought, the Fed dot plots would be. Essentially, option investors now have said, we have no idea what is going to happen in March in the context of what's happening in Ukraine. Essentially, people are taking any hedges that are new and they're throwing them all into May and June. They're basically saying, look, this is going to be highly uncertain for a long period of time. We don't know what happens in March anymore. So we're going to go down the line and just say that uncertainty continues for the next few months.
Okay, so they're pushing out their hedges. How expensive are those hedges, Amy?
When you look on a percentile basis, 3 years, 1 year, 5 year, what have you, they're all at historical highs. So sometimes it's important to compare them to other markets. And what I will tell you is if you look to the fixed income market, the volatility levels are hitting essentially the March 2020 peaks. And we are nowhere near that in the equity volatility markets. So, we have a 33 on the VIX or so. But VIX hit 80 back in March of 2020. So I actually think that equity volatility still has a long way to go up, despite how everything looks pricey, on those percentiles.
Mike, the Fed has retreated from forward guidance over the last few months. It is much more opaque now in terms of the guidance that it's providing. We have, as you've just laid out, little clarity over whether we get a 25 or a 50 basis point hike. Given the fact that we have this geopolitical uncertainty right now, do you think the Fed is going to want to be a little bit more careful in terms of the guidance that it provides, maybe providing a little more clarity on the path that it sees rates being on?
Well, I think you've got both points right, but in the opposite order. The Fed is going to want to have as much choice, optionality as it can possibly get. So Powell will try probably to not let anybody pin him down about what they're going to do and how often they're going to raise rates. But they don't want to raise rates too quickly. They may not need to. Interesting comment from Jim Bullard just a few seconds ago saying that the market is going to price the Ukraine risk for the Fed because they're going to have their finger on what kind of damage it's going to do. And obviously the markets are pricing Europe in a lot worse shape than the U.S. at the moment.
Yeah, and Jim Bullard going on to say there could be a reordering of the global oil market. Mike, you were talking about how we're all focused on the hikes, whether they move 25 or 50 basis points, how many times they move this year. What about the balance sheet? How is that maybe adjusted in relation to some of the uncertainties that they're faced with?
They probably haven't changed their views on that at all. The problem for the balance sheet reduction is the Fed doesn't have a good mathematical model of what the impact of a falling balance sheet is on financial markets in terms of what does it mean compared to raising or lowering interest rates. So they do want to raise rates first. That'll be their primary tool. They know the balance sheet has to come down, so they will start lowering it. But they don't look at shrinking the balance sheet as a particular tool of monetary policy, more a right sizing that they'll know they get there when the market starts to react as it did in 2018.
Amy, do you see any sign of stress in the system right now? Is this a market that is functioning properly? There have been some concerns, particularly about the funding markets, but from what you see in front of you, is this a relatively normal situation that we find ourselves with from a market perspective, obviously not from a geopolitical perspective?
Yeah, as far as the equity options market goes, it's still functioning in an orderly way. I think the liquidity on kind of the rates volatility side is very different right now. And, look, this is a little morbid to think about, but when you think about the real tail risk that is in the equity market right now, what is it? It's nuclear war, right? There's simply no way for the equity options market to price that, because the reality is if that happens, there is no equity options market to price, right? So in some ways, the equity options market has to be more sanguine, and you see that in kind of the normal functioning of both volatility as well as options volume.
On kind of the subject of liquidity, obviously the abundance of it is what fueled a lot of the retail activity we've seen really over the last 2 years. A lot of that had been buying bullish call options. Now we're starting to see them actually in quite force pursuing put options. That's pointed out by Jason Gopfert over at Sundial Research. How does the retail trader influence what these markets are doing right now?
Yeah, it's interesting because after 2 years of buying out of the money call options and YOLO and meme stocks or what have you, that sentiment really has shifted, hasn't it? And I would say, it's not just retail. Institutions are also buying puts to a large degree. So, one technical aspect that we have to continue to watch in the options market is what happens when that hedge monetization occurs. So, meaning when the hedges close, you actually can get support to the market. This is actually what happened last week between Wednesday and Thursday. There was a great amount of hedges actually being closed, which forces the dealers to essentially cover the shorts that they had on, which provided a little bit of that turnaround we saw to the market last week. Now, normally we would say retail, who cares that, they're a small portion of the market. We've learned in the last 2 years that's not true. They can have significant impact. So when you see that snowball onto institutional trades, you better watch for those changes in support and gamma as well.
Amy, what's happening with single stocks right now in terms of the moves that we're seeing? Do you have any visibility? There are a bunch of stocks that are directly affected by what is happening here. Some of them are in Europe, some of them are in the United States. Obviously, anything with Russia exposure is being whipsawed right now. What are you seeing in some of those single names?
It's interesting. We actually had a conversation about this with our team this morning, which is there's just very little appetite from investors and clients to listen to anything about single stocks right now, even if they are directly related, like an energy name. It's a very macro world, and when it's kind of geopolitical headlines all the time, the reality is correlations go very close to one. So, a lot of the activity right now is macro. It's your proxy ETFs, it's your indices. And even if there are earnings coming, people aren't as focused on those single stock names. However, I think that, as these continued announcements come for these ESG related sanctions or, companies basically choosing to do things related to Russia, I think you're starting to see that divergence again as the news flow happens.